Today I'll talk about a couple who's interested in whole life insurance, but they'd like to have a minimum premium so the policy never feels like a burden. But when their cash flow allows, they'd like to be able to add more money to that policy to grow the whole life insurance benefit, but also grow their cash value. So I'll show you exactly what they're looking at. So what we've got is a couple in their late 30s. Both the husband and wife are 37 years old. And the husband called me and let me know that he was interested in a life insurance policy of about $250,000. He has life insurance in place, but he said, Steve, with everything costing a lot, I would like to have more coverage just on me and my wife in case something happens. I would like to build cash value, but only if it makes sense from a cash flow perspective. Meaning I don't want to lay out a lot of money for a whole life insurance policy because if it costs a lot, I'll just get a term policy. So he's interested in a whole life insurance policy, but only if the minimum is less than $200 per month. That's what he wants, and he wants to make sure that he still has that $250,000 benefit. Now, he would like to be able to add more money to the policy, and the question is it possible? Meaning, can I have a policy where I have a $250,000 death benefit, my minimum is $200 per month or less than that, and I have the option to add more money whenever I want to grow the cash value? The answer to that question is absolutely yes. And I'll show you that in a moment. So the minimum for a $250,000 whole life insurance policy depends on how you set it up. If you're 37 years old and you just buy a 250 grand whole life insurance policy, that's not going to be cheap. So if you have a policy for 250, it's going to be close to $4,800 per year. Call it $4,800 per year. That's not $200 per month. But that assumes you just buy a basic whole life insurance policy, which I would definitely not do, just knowing what is possible with life insurance. So you could actually set a minimum premium at close to about $750 per year and have a 250 grand death benefit by using what's called a term insurance rider. I'll show you exactly what that looks like. You would have the option to add more money to the policy. Adding more money to the policy will grow your cash value, and it will also grow your death benefit, which is nice. So a question that comes up sometimes is, all right, that sounds great, Steve, but how do people actually do that? Like if I buy a life insurance policy and the premium is $750 per year, like do I just send money to the insurance company? And then like what actually happens with it? Depends on the company. You're going to see that he's looking at Guardian, and how it works is he'll have an online portal, a mobile app, or he could just mail in a check. But this is how he can actually send money to his policy. And how he would send money to the policy is through what is called his paid up additions rider. He would immediately see this impact his cash value in a positive manner, meaning it would grow cash value. And he would also see a greater death benefit from a long-term perspective. Initially, the death benefit will stay at $250,000. So why he would add more money to the policy is because, one, it'll give him more cash value immediately, which will begin to earn a positive return. Also has a nice tax benefit, he likes that. But also, it'll help keep that death benefit at $250K forever and eventually increase it as well. And then down here, how long do I have to pay? This is a really good question. If you pay just the minimum, you'd have to pay for a long time. He's 37, at least until he is 65 or so, in order to maintain that $250K death benefit. And eventually it will drop as well. We would have to drop it. Now, if he pays more than the minimum, say $200 per month, or he stuffs it with $400 per month, that's really going to accelerate the cash value growth, and it will also allow him to fund the policy for a short period of time, which is nice, which I'm going to show you that. So what we'll look at is the policy we showed him, and he said, I'd like to proceed with that, and then the same product, but for his wife. So what we've got here is his illustration, where you can see a minimum premium of $730, and what he's paying is $730. Before I just jump to this though, let's take a look at the actual life insurance illustration. So here we go. He's 37 years old, non-smoker, just a standard non-smoker rating. And here's what I want to hit on. So this illustration, I'm going to show you on Excel in a moment, shows $2,400 per year going in, or $200 per month. This is what he said, hey, this is like no problem, this is great. He could even put it at $100 per month if he really wanted to free up his cash flow. But of that $2,400 per year, up here is his premium. This is what is called the base premium. Here is the cost of the term insurance rider, so call it term rider premium. So the true all-in minimum would be those two combined. We rounded up to about $730. The reason why is because Guardian has a rule. If I'm adding PUAs, the minimum yearly amount is $250 per year. But that PUA amount will actually cover the term insurance rider cost as well. I know that's confusing. Point is, the all-in minimum, if I want the option to add more money to the policy, is going to be this plus $250, about $730 per year. So let's take a look at that, and then we'll look at the illustration we see up on the screen right now. So $250,000 death benefit. Does he have that? Yes. For how long? Through about age 60 in this example. What we did here is show what it looks like if he pays just the minimum and went with this instead of call it a 20-year term policy. So after 20 years, he's paid a total of $14,600. He has some cash value. With term, you'd have nothing left over unless you went with like a return of premium or something like that. Has a $250K death benefit. We kept the term on for a little bit longer, up until about age 62, or 61, I'm sorry. There we go. And then we reduced it. So he's got some cash value here. This example is not ideal. However, not ideal if you're trying to build cash value, I should say. However, in his particular case where he said, the goal is life insurance right now, show me the minimum, and I know I can add more to it, and if that makes things look better, that's great. Let's look at that. So he wanted to see what? $200 per month. Here's the illustration we looked at, and the point I want to emphasize here is if this is you, here's what it looked like with the minimum only, and here's the exact same policy, but just showing what it looks like if you add money now to your PUA rider. And what we're adding is the difference from the minimum and $2,400. So if you said, hey, all these terms are confusing, the only thing we need to know here is that the minimum or that the out-of-pocket is $2,400 per year or $200 per month, which makes the cash value look a lot better. What happens down here? Check this out. Paid in a total of $60, you've got almost $90,000 in cash value. You still have that $250K death benefit. However, when we stopped funding, we dropped it. And why we did that is because it allows the cash value to grow at a faster pace. But this shows funding the $200 per month. If he wanted to keep the death benefit at $200K, we could. You might have to fund a little bit longer, or $250K. You might have to fund a little bit longer, but we could do that. And the numbers would still look attractive here. Break-even point here, year 8, which is not ideal for a high cash value policy. But remember, we're targeting life insurance here. So we're planning from a life insurance protection standpoint. All right. Now we've got what I like to call the good one, which depends on his cash flow. So here, he's funding $4,800 per year, exact same minimum, which means literally he can set this up so he gets a bill for the $730 one time per year, or he could pay it over 12 months. And then when it comes to adding money toward PUAs, it's 100% at his discretion. He doesn't have to add this much. Some years it might be zero. Some years it might be $1,600, $1,000, $3,000. It's very flexible where he can add extra money at his discretion. Of course, the values would look different from what we see here, but he can do that. So a lot of people aren't aware of the fact that you can fluctuate your payments and you don't have to follow what we see on the illustration, which is nice. Now, what you'll also find is if we do add more money to the policy, look at this. You've got more money in cash value between 4 to 5 years than what you paid into the policy, which is nice. Also, by 52, he stops paying altogether. And what happens to the cash value death benefit? It keeps going up. Check that out. It's pretty neat. A lot of people aren't aware that you can do this kind of stuff with life insurance. And it just keeps on compounding over time. So that's his policy. If we look at his wife's, we've got the same thing. Because she's a female and will likely live longer, according to actuaries and insurance statistics, the true minimum, that's the base, plus the $250 minimum, is $682 per year. In fact, if you'd like to see the actual minimum, there you go. The base is about $430 for her. Again, that's because she's a female, even though they're the same age. But if we look at the same thing, there's the minimum. There's $200 per month. And there's max funding it. Instead of $4,800, it's about $4,600 per year. But same thing through age 52, and then just let it ride over time. We've got the cash value and the death benefit. But the purpose of today's video is really just to show people that when you're shopping for whole life insurance, what I would not do is just ask for a certain death benefit. Because usually what you're going to be shown in a case like that is just a price-quoted whole life insurance policy with a very high premium commitment that is the most profitable to the agency, agent, and insurance company. So it's natural that that's going to be shown. But instead of doing that, like you can ask for a death benefit, but if your agent does not say, hey, do you want to keep your premium at a minimum? Are you interested in how you can keep a minimum, but also get cash value? Do you want to show you would you like to see what I would do in a case like this? Like if they're not showing those options, I would ask, can I see a minimum premium? If they say the premium is what it is, ask, can I add a term insurance rider to the policy? How low can the premium be relative to money I add toward PUAs? A lot of companies like Guardian, like Mass Mutual, like a lot of your 4 major mutuals will allow you to pay up to 10x your base premium into PUAs per year. So if you specify that to an agent, then they're more likely to show you that. So sometimes you do have to ask. Some agents will show you that, but I would always advise that. Anyway, I hope you enjoyed this one. I would love to hear your comments, thoughts, any questions, please leave them in the comments section below. If you'd like to connect, please visit our website, ibcglobalinc.com. And if you'd like to see another video that demonstrates starting a whole life insurance policy with a minimum amount, you can check out this video here. Thanks so much.